Usually the first day of trading coming out of the into the new year, you get a good indication of which sectors are going to be the strongest and which are going to be the weakest, at least for the first quarter. This is because everybody that's in the money management business have made their assessments during the holidays of what they're going to do for the next year, and usually they come out of the block with some great strength. However, we don't see any major change from what was going on from the previous trend prior to New Year's or during the Christmas holidays. All we can do is one simple analytical analogy or analysis is that as long as we don't close below the T line, we're still in an uptrend. Today the Dow closed right at the T line. The S&P 500 closed right at the T line. However, the Nasdaq closed below the T line. What's this kind of telling us? That there really isn't any massive selling yet. We may be just in kind of a pullback like we saw here, but until we see a definite sell signal and a close below the T line, we've got to consider we're still in an uptrend. And an additional evidence of that is the fact that there's too many stocks that are still acting positive. We have recently been recommending, not recently, we've been recommending Scotty, SCTY, ever since it started breaking out through this downtrending channel, ever since we had the slow curve. And notice what it has not been able to do for the last month is it hasn't been able to close below the T line, and we're still in an uptrend and had a gap up today. This is the type of bullish sentiment that is telling us that there is not any major change of investor sentiment right now, that things are still acting or still going positive in some areas. And JKS is another example of a fry pan bottom doing its own thing despite what the market is doing, based upon we're not able to close this below the T line ever since they've popped it up off the moving averages. There's our little inverted hammer, followed by a gap up doji, followed by positive trading breaking out through here, even though it pulled back. One simple premise: as long as it does not close below the T line, you consider you're in an uptrend. And today they gapped it up, meaning they're probably breaking out through this level, taking us potentially up to the top of this trend channel, which means even though the market is soggy, there are still price patterns out there that can be easily recognized using candlestick analysis that the bulls are still going after with great enthusiasm. Our recent recommendation on QUIK, also coming out of this fry pan bottom, having used the 50-day moving average as support. Again, this is not rocket science. This is just using the patterns and signals that the Japanese rice traders have identified over the past 4 centuries as being indications of where the bulls are trading and where the bears are trading, and putting us in situations where the probabilities of being in the right place at the right time are extremely good. That'll be it. We'll see you in the chat rooms.